Warm welcome to another week ahead video, guys. This week's focus, of course, will turn to the trading week between the 15th and the 19th of March 2021, where our focus will be firmly fixed on the upcoming FOMC meeting that we have on Wednesday. Now, over the past few weeks, as you guys know, the major focus for the market has really been on the drastic move higher that we've seen in global bond yields, with those in the US, of course, leading the path to the upside. And, going into this year, it's not like market participants weren't already expecting yields to rise. It was a major consensus view going into the year, as seen in this survey done by Bank of America. So why all of this fuss about the move is if it was expected by the markets to happen already. Now, the move higher wasn't really as much a concern as the pace of the move itself, which caused sharp rises, of course, in bond market volatility that spilled over into other major asset classes. And taking a look at the US yield curve above, we can see the sharp contrast between the current curve that we have in orange, between that of middle of January in blue, middle of February in green, and now just a week ago in purple. So just a massive steepening going on in terms of the US yield curve. Now, according to recent Fed communication, they haven't been too worried by the rise in bond yields, as they said that, and rightly said, that they do reflect the market's overall expectation for an increase in growth as well as inflation, even though it's going to be cyclical inflation as opposed to secular rising inflation. Now, the challenge with the rise that we've seen, we've also seen a sharp repricing in interest rates, which Fed Chair Powell did not really seem too worried about with his prior speech that he had for the Wall Street Journal 2 weeks ago. Now, due to that rise in yields that we've seen interest rate markets price in much faster policy normalization and reflect much tighter financing conditions. With Eurodollar futures on this screen, we can see the one in blue is the September 2023 contract that is pricing in just over 3 rate hikes for the Fed by September 2023 versus pricing less than 1 at the end of December and just over 1 hike just at the start of Feb. So a massive repricing here, normalization. And that means that there will be a lot of focus in this upcoming FOMC meeting to see whether the bank sticks to that nonchalant approach to yields and interest rates, or whether they choose to put some brakes on the recent sell-off that we've seen in those longer dated treasuries. So turning to the week ahead, what will the focus points be for this FOMC meeting? Now, the Fed will release their summary of economic projections, where markets are widely expecting the bank to upgrade their growth forecasts to close to or above 6% from December's expectations of 4.2% due to the massive success that we've had in the vaccination rollout, as well as that the passing of that 1.9 trillion fiscal package. Unemployment is expected to fall slightly in the projections, and inflation is expected to remain very close to the December median expectation of 2%. Now, there are 2 very important questions for this week's meeting. The first revolves around the Fed's dot plot, and the second one will revolve around the Fed's comfortability with the recent move, of course, that we've seen in things like yields as well as rates. Now, at the December meeting, we only had 1 Fed member expecting a hike by 2022, while 5 members expected 1 hike by 2023, and the rest saw only 1 hike, with the earliest being 2024. Now, given the positive expectations or developments we've seen in recent weeks, it's likely that some of the members that were only expecting 1 hike in 2024, that some of them will be bringing forward their projections to possibly expect a first hike now by 2023. And the big question is whether there are enough members shifting their votes to see the median forecast shift from expecting 1 hike by 2024 to now expecting 1 by 2023. That'll be a very significant change in the market's eyes. The second question is whether the bank will decide to bring calm to the recent bond sell-off and tighter financial conditions. And if they don't do anything about it, the ongoing fear-mongering narrative of runaway yields, and that could pose real bigger challenges for risk assets if the rise in yields cause drastic further tightening of financial conditions. Furthermore, if the Fed allows the tightening of financial conditions to continue, that is going to create a big tailwind for the US dollar. And even though that medium-term bias for the US dollar is still tilted to the downside, if we start to see these financing conditions really starting to tighten up even additionally, it's going to create some upside momentum for the dollar. And remember, there's a ton of short bets and that could still be unwound for those dollar bears. And if that starts happening, it could create a big squeeze high in the US dollar. And in that situation, with the dollar rising rapidly, it'll put some pressure on risk assets across the board and also put additional pressure on things like emerging market equities and their currencies as well. Now, there's a couple of things that the Fed can do this week. Firstly, turning to the supplementary leverage ratio, they could extend the relief for banks, which is due to expire by the end of this month. With the 1.9 trillion fiscal bill now approved, the US is expected to drastically step up issuance. And if the SLR is not extended, it could get very difficult to find buyers for all of those additional bonds. And that'll put additional pressure on the Fed to step up purchases. The other thing they could do is looking at weighted average maturity. So they could extend the average maturity of the bonds that they buy. So keeping the pace and the amount of QE the same, but just focus the bulk of their buying towards the back end of the curve to basically drive yields lower in the back end. And the other thing they can do is, of course, another operation twist. They could perform another twist like they did back in 2012 by basically buying bonds at the back end of the curve while simultaneously selling bonds at the short term end of the curve, which flattens the curve by pushing short yields up and longer yields lower. And the other bigger tool they could use is yield curve control. They could announce that, giving the bank the opportunity to buy as many bonds as they need to make sure that yields stay capped at a specific level. We obviously know or have seen that for the Bank of Japan and the RBA as well. Now, something to keep in mind is that with the new issuance expected in the months ahead due to that stimulus package, yield curve control is an option, as it would allow the bank to buy whatever they really needed and could pave the way for them to pick up the slack, so to speak, if there's any lack in demand really, and potentially moving towards a taper tantrum, starting developing. They would have the tool they need to basically step up bond buying if they needed to. So right now, consensus seems to be leaning towards a possible extension of that SLR, that supplementary leverage ratio, being announced, but not expecting the Fed to act on any or announce any of the other measures like weighted average maturities, operation twist, or yield curve control. So consensus expecting the median dot plot to stay in 2024 and expecting a possible extension for that SLR. So that brings us then to possible sentiment shifts and trade plans that we can look at. Now, the first scenario would be the potential dovish outcomes that we have for the meeting. We've basically broken this down into two separate matrices. So the first one is dovish to overly dovish, ranked 1 to 4, and then expected asset reactions that we can see in the markets. Now, looking at potential dovish actions from the Fed, the first one would just be Fed Chair Powell coming out, stepping back against these prior comments he made with that Wall Street Journal interview, and have some verbal intervention against the rise that we've seen in yields and rates. That would be a dovish reaction, but probably the least dovish one. If he did that, as well as we saw the dot plot remaining unchanged with that median at 2024, that'll be more dovish. If he then announces an extension of that SLR relief as well, that's probably going to be more dovish. And the most overly dovish reaction is probably going to be all three of those ones, with the announcement of a possible weighted average maturity, yield curve control, or an operation twist. And these are the expected moves that we would expect to see in terms of asset reaction on the back of that. Looking at potential hawkish outcomes, now do keep in mind that the Fed chair wasn't really concerned at all about the rise that we had in yields and rates during that recent interview. So if he comes out and there's absolutely no verbal intervention against it, that'll probably be more of the one of the more neutral reactions, not expecting any type of real changes in major asset classes on the back of that. If that's the only thing that happens, if it's just as is, dot plot remains unchanged and there's no verbal intervention. Now, looking at a potential hawkish outcome on the back of that is if we do see that dot plot median go from 2024 to 2023, that's going to be a hawkish signal. In that environment, we would expect to see upside for US 10-year, upside for the dollar, downside for equities, downside for gold. If we on the top of that see an announcement that the SLR relief will not be extended, that's going to be even more hawkish. And the most hawkish would be no verbal intervention, dot plot change to 2023, no extension on the SLR, and of course no announcement of possible incoming yield curve control or an operation twist. Now, do keep in mind that the potential outcomes and the potential market reactions in this report, it's merely a guide for what we would expect in the event of various outcomes. So please keep in mind that the market can always react in different ways as opposed to the expected outcomes. And this isn't intended as trade calls whatsoever. It's really intended as a guideline and framework for your own scenario planning. So as always, guys, if there's any questions, please don't hesitate to let us know. and we hope you guys have a fantastic trading week ahead.